Welcome to another episode of Equity Mates, a podcast where we explore what's possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you going?
I'm very good, Bryce. Very excited for this episode. We are joined in the studio by financial media royalty.
Yes.
Yeah.
Thank you.
Australian investors who are self-taught and trying to keep learning, probably are familiar with Ali Selby. Welcome to Equity Mates.
Thank you. Thank you so much. I'm really excited to be here. Interestingly, I dyed my hair recently and no one recognizes me anymore.
Really?
So I don't know if I'm royalty anymore. I feel like the ego has really been shattered recently when people are like, and you are?
So Ali is head of marketing distribution at Minotaur Capital, but yeah, as Ren said previously, the face of buy, hold or sell at Livewire. And yeah, I think a lot of people are familiar with the work that you've been doing. So today we are going to be going around the room and sharing a number of key lessons that we've learnt from interviewing collectively hundreds of fund managers and
if not thousands.
Yeah, we've done more than 500, and I reckon Ali's done more than 500. So
thousands of interviews. So we have a lot of lessons to unpack. We're going to do 3 each.
Yes.
And we're going to start with you, Ali.
Okay, so something that 2 different fund managers have told me is that you should look at your portfolio with fresh eyes every day. So basically, look at your portfolio and say, if I know all the information I know today, would I buy everything again? And if not, then you should probably sell it. I have not done that because I am an idiot. I have definitely not done that, and I've held onto stocks that have just plummeted, or like Mineral Resources, like Zip when it was out of favor. So I think it's a really good piece of advice to just look at your portfolio and be like, with all the new information I have today, I probably should sell this stock rather than just holding on for dear life.
We've had an interview on the show, a guest who says, if it's not a buy, it's a sell.
Yeah.
And I think that's along the same lines. It's just because it's in your portfolio, you shouldn't just hold it.
100%.
Either love it or get rid of it.
Yeah.
I would say quarterly for me is probably where I would stretch that to, because I feel like daily you can eat. I don't have the time for that, to be honest.
No, but you probably should be owning ETFs then.
I do.
Yeah, which I know you do. I do know.
I'm the index boy.
But I don't. I own lots of stocks.
Individuals. Do you think though, if you've done it,
ETFs too, but I also own a lot of random stocks.
Do you think if you had put this into practice though, you would act on it? You would genuinely be buying and selling more actively?
I don't know. I feel like if I think the learning is, because I'm not looking at my portfolio all the time, I probably should have just invested more of my money in ETFs rather than being having some ETFs, having some random stocks, and then just not really knowing when to sell.
I guess one of the challenges we all face, having, great access to good fund managers as well, is the excitement you get from the interviews.
Oh, there's nothing better than a stock tip.
And a stock tip. And you go away and you buy Mineral Resources, whatever it is, and you think, best company ever, and then you do no work on it. You don't know.
God, they sold it well.
I feel I've been good. I do my own research, but then I'm I forget about it.
Yeah.
And I don't follow up when it reports, which is stupid.
Yeah.
Things like that.
Yeah.
All right, well, that's a good one. Good lesson number 1. Well, Bryce, why don't you kick us off? What's one lesson that you've got?
For me, my first is that the most successful investors are relentlessly boring and they do less for longer. Fund managers that come to mind where they come in and they say, I've been, looking at this stock now for 5 years and now I really understand it and I've I only make 3 trades a year. It's those are the fund managers that I think show continued success over a long period of time.
Waiting 5 years before they invest in a stock, or they've been following the stock for 5 years?
Both. We've had fund managers.
You'd miss it after 5 years.
Well, I think
is that a good piece of advice?
I think the point for them is we've understood it, and now a lot of it then just comes down to we're waiting for the right times to enter it.
Yeah,
it's we're waiting for the market to we've been watching it, we love it, and now it's at a price that we're willing to buy it. And I think having that patience and doing less, not feeling the need to turn your portfolio over 10 times a year or whatever it is, those that come in and just say high conviction, 10 stocks, and I'm only going to make 2 trades a year. Like, I think there's a lot to be said in that.
Who comes to mind when you say we've spoken to fund managers that are like that?
So early days, Chris Weldon at Magellan, I think he was a good case study. But the Fairlight guys for me, they just are so methodical, and the conviction they have in stocks from just doing such deep research and not feeling pressured to make investments, every quarter or whatever it is. Griffin, like there's a lot of them that just come in with a sense of calm and patience that I think, we can all learn from.
The other one for me would be TDM.
True.
Yeah. We went into their offices one time and it was so quiet and calm.
Chill,
and it was like, this is what investing should be. Everyone was just reading, and I was like, I'd love this as a job.
Yeah, it is an incredible job. I was talking to Kath Allfrey about it the other day, who is like my hero. Just saying what an incredible job she's had traveling the world and meeting all these incredible CEOs. Like, being an investor is an amazing job. I wish I had done that instead of journalism, but journalism is also an awesome job as well.
You're slowly making your way further and further into funds management.
Weaseling my way.
Yeah.
What about you, Ren?
So number one for me is there are plenty of ways to make money in the market. I think when we started this podcast and this journey of Equity Mates, I thought that it was a debate and that there was one right answer, that, different investing strategies, value v growth, different asset classes, property v stocks, and different sort of time horizons like trader versus long-term investor, they were all debates. And the challenge for us was to figure out who was right, and whether you made money or didn't make money, or the amount of money you made depended on your work in figuring out the right way to navigate this world. But that's just not the way to think about it. Like, everyone is making money. It's crazy how many ways there are to make money. And like, people make money at different times and in different ways. And they obviously make different quantums of money, which is the name of the game, I guess. But there's no one right answer. Like, that's been really liberating in terms of like how I think about investing and what I try and learn from all these different investors. Yeah.
You can come unstuck though if you try all of them.
Try
and
do
once.
everything, yeah. Although, like value v growth. Like, if you do either well, you'll make money. Property v stocks. If you do either well, you'll make money. Long term versus short term.
Yeah.
If you do either well, you make money. So you can come unstuck if you do them poorly.
Yeah.
But I think like as long as whatever you're doing, you do well and you do sensibly and you remain disciplined, you'll do all right.
Yeah.
Yeah.
One, I guess, I don't know if you've interviewed many technical analysts, but I don't think that's one sort of part of the market I don't think we've done a lot of.
You've read one book on, I don't even reckon you finished the book. And there was about, I reckon, a 3-month period where Bryce decided he was going to learn to read charts and become like a technical trader. Didn't go anywhere.
I've interviewed, we did this thing where we interviewed all our readers, and one of them was like a technical trader, and he had like lost a lot of money and made a lot of money. I don't know.
Yeah, it's just not for me.
It's a way of investing that seems way too emotional for me.
Too intense.
All right, what's your second, Ali?
Okay, my second is going to be that everyone has biases, whether you're a punter or a pro. Everyone suffers from FOMO, unfortunately. And everyone also says that they can stomach volatility, but what they really mean is they can stomach volatility when markets are going up, probably not so much when they're going down. So I think it's really important to learn how to battle your biases and also know which impact you and which don't. Everyone's different, everyone's impacted by different things. Obviously, I really suck at selling, so I need to work on that. Maybe for you it's something else, but I think it's really important to know what your biases are and try and manage them.
An expert that comes to mind for us when we've done interviews in that space is Ted Richards. We did a few interviews on him around the importance of understanding your biases, but it can take ages to figure it out and be conscious of them.
Yeah. I think it's really interesting. I'm working now at Minotaur Capital, which is Australia's first AI-powered hedge fund or long-short global equity strategy. But we're using AI in really interesting ways to help us battle those behavioural biases. Knowing that we will face them all the time. We've come up with this thing called a thesis validation or invalidation report. When a company reports, we press a button and it like generates a report from us going through all the documents, like the reports, the transcript, whatever it may be. And it tells you like, here's your thesis, here's all the information in the report that challenges your thesis, here's all the like information in the report that confirms your thesis, and then it gives you a recommendation. So for example,
that's epic.
Yeah, it's amazing, because like you want to know like, is the story that I had in my mind, is that thesis still on track? And if not, it's like, probably should sell that stock and move out, or rather than like, I don't know, thesis drift, which I've definitely talked to fund managers about before, and you're like, oh, that's changed since you, like for the people who hold stocks for 5-10 years, and you're like, that thesis has definitely changed from when you last talked to me about it.
Convincing themselves.
Yeah. So I think that's really cool. Maybe investors can like use AI to do things like that as well, like we're doing.
Yeah, we were looking at building our own GPTs, because you can do that with ChatGPT now, and we could probably not as complex as what you guys have built, but there's probably something we could do there around quarterly reporting time and checking our own portfolios.
Definitely. Yeah.
So in your spiel earlier, you said you struggle with selling, so you recognize that about yourself. But when you were speaking earlier, you've said you have a lot of stocks that you probably aren't paying too much attention to. So if I'm putting 2 and 2 together there, you're aware of your bias, but you're not taking active steps to control it?
Yeah. Don't be like me. Don't be like me. I think I'm just very busy, and I need to just sell everything and invest in ETFs.
Oh, that's the lesson that we just repeat over and over again. We drill it into people's heads.
But if you enjoy
nothing
it,
wrong with ETFs.
Yeah, they're fine. They're cheap. Like, I think it's fun though, investing in individual stocks. And like I have
both.
Santos. That was
that was good. Yeah, well done.
It was shit the last few years, but
so
now I feel really smart.
If you had sold, you wouldn't have got. Well, the buyout hasn't happened yet, so
no,
maybe sell.
Yeah. I need to make better decisions with my money. But I've definitely learned a lot of things from interviewing fund managers. I was just saying before, I feel like I haven't actually applied them, but there's still time.
There is plenty of time.
Yeah.
All right, Bryce, what have you got for us?
Number 2 is conviction is a muscle. And it really comes from just doing repetitive work. And I think if you look at some of the best investors that we've spoken to, the main thing that they talk about is just sticking to their process. It kind of feeds into what you're talking about, Ali. Like, they just have such a process and do such huge amounts of work to come to a point of conviction that it takes away a lot of the emotion that probably goes with it. It's like, if we know that this is a tried and tested process, and regardless of what markets are doing, and regardless of what the macro environment is, and regardless of how I'm feeling as a person, like, the process speaks for itself. And like, just repetitively doing that over 20 years and slowly refining that process, I think really helps to build that conviction. Because you have a lot of people come in and say, my number 1 conviction stock is X, but like the work that's gone into that. I remember speaking to Yen Liao.
Yeah.
And he was saying, what was it, 4,000 hours he was doing for a particular stock.
Wow.
Which is just ridiculous. He did then...
He's probably not a great example.
He did then close his fund down after that interview. So anyway, we'll take the first part of that. But yeah, like, I think the process is important. Big thing that most successful investors have, like, Buffett, like they just have such a clear process. And they do not go outside of that.
Well, you want to be able to demonstrate that your process is repeatable.
Yeah.
Over the long term, through various cycles.
Yeah. You're not flip-flopping around. Yeah. And now I'm growth, now I'm value, now I'm this, now I'm that.
So if that's what you've learned, what's your process?
Dollar cost average into low-cost ETFs, maybe. Repeatable, defendable,
True.
successful.
All right. Good process.
Right, really good process. And check every quarter that I've got the best ETFs.
Yeah.
What's yours, the second, Ren?
All right, second one for me is that trends last longer than you think. And so for this one, I think there's an idea that you need to find like an unknown gem, and that's, you buy it early and then people discover it, and that's how you make money. And that's certainly a way to make money. But I think the story of so many companies that has sort of grown up with us over the past 10 years is that the tailwinds that they were riding, or the business that they were building, like, we had so many opportunities to buy it. And like, examples that come to mind for me is like Spotify. Like, so many people have thought over the journey, Spotify is like, it's global, it's saturated, it's well known, like the opportunity's past. But if you'd bought it, like 2 or 3 years ago, you would have doubled your money. It's like the trend, like the business kept growing and kept improving for a lot longer than we thought, and a lot longer than it was already a global giant. Similarly, like the e-commerce trend, and like a company that I own is Shopify, but like Amazon and stuff as well. Like everyone kind of thought like e-commerce is known, the disruption we're speaking about, everyone's aware of it, but like the trend just keeps going for longer than we think. And so we have all these opportunities to buy these companies that are known, but have like huge runway ahead of them. NVIDIA, classic example. Like we kind of thought, oh, there's so much hype in AI, it's too late, but it's like the trend lasts longer than we think. And so you don't have to find these undiscovered names. You can find great companies that have great growth runways ahead. And I think the investors that we speak to, but particularly for me, when you look at 13Fs, so for people unfamiliar, big funds in America and in Australia that have big US holdings, every quarter have to file a 13F that says what their biggest US holdings are. And the holdings are always like well-known companies. And it's like these guys aren't, the best investors in the world aren't finding like undiscovered gems. They're buying big companies but have like long growth prospects ahead of them. And for me, that's just a lesson in where you need to look to find great opportunities.
Yeah, I love it. Sometimes the big is the best.
Yeah, as long as it can keep getting bigger.
Yes. All right, Ali, bring it home, number 3.
Oh, I'm a little bit scared about doing my number 3. I'm kind of like putting the industry on notice.
Good.
No,
Good.
or just like opening up about like the behind the scenes of media. So I feel like going from working in media for like 8 years and then going into the distribution marketing side for a hedge fund, it's been really interesting. I think I knew like how much content was sponsored, having worked in like financial media for a while, which sponsored is like people pay for that interview or for the video or whatever it may be. And then going on the other side, it's like I didn't realize how many events were also like paid for. Like people are paying like $15,000 to $60,000 to speak at events. And then like investors are paying like $4,000 for tickets to go to these events. Like I feel like the best people are not speaking at these events or being interviewed by like journalists. It's like the people who can pay for these interviews, which is kind of sad and really annoying. Luckily, I've worked in media for a really long time, and so I've been able to like pitch our fund to journalists without like having to pay for anything, because I know what journalists are looking for. But I feel like it's interesting to see like how much content out there is actually sponsored.
And so is the lesson sort of buyer beware for everyone, or like
I think
it was just something that now that you've seen both sides, it's like...
I think the lesson is like you have to be really like cognizant of like how media works, and then also just know who to trust. Like you're giving someone your money. If you're giving your money to a fund manager, you should demand a lot from them. Like you should be able to call them up and talk to them, or like you're giving them your life savings. I don't think that's a lot to expect, particularly if they're based in Australia. I think also just like being aware, like to read lots of different articles. I don't know about you guys, but I think if you're reading anything about private credit, it's probably been sponsored. Or private debt.
A lot of money in private credit.
Yeah. I think it's just like you need to be aware of like which sources are paid and which are not. That's why people don't really trust journalists anymore. It's difficult out there. Like even we're applying to be on a list for innovative companies, and we've just coughed out so much money to try and be on like the running for that list. And I had no idea that those lists were pay to play. Yeah, it's really hard. I think you just have to read a wide variety of sources and do any research, like do your own research before investing in a fund or investing in an ETF or investing in a stock. Like you have to do your own work because like people are trying to get as much money from you as possible.
My final one is, again, on the professional side, I think it's that professionals have constraints on how they can operate, but us as fund managers of our own private investments have no constraints. And I think you can get really confused and overwhelmed when investors talk about what is good like principles about investing that can sort of mislead you a little bit when it comes to your own. Things like letting winners run. Like a lot of fund managers have restraints on what size they can actually allow certain positions to get to in their funds, and so clip a lot of or sell a lot of their winners. Whereas as retail investors, we should just be letting our winners run for as long as possible. Things like, you shouldn't have more than 5% allocated to one particular stock. If you've got an awesome stock, like allocate to it. Things like time horizon. A lot of fund managers say long term is 7 years. Whereas for
3
us,
to 5 mostly.
3 to 5,
Yeah.
Whereas for us, long term is 4 decades.
Yes.
So it's like the way that they speak about like what good investing is, I think can really mislead you when you think about building your own portfolio early days. So I think just be clear around their incentives and why they're saying these things.
Yeah.
Even just to add on that, like small cap managers, like as soon as a stock
This
is too big
Yeah,
and
it's
goes
not
into like the ASX 200, they can't invest in it
Yeah.
anymore.
ridiculous.
Yeah.
So then it's like it's no longer going to be a stock that they talk about or they're excited about. They can't invest in it. So
We had one
nuts.
fundie though, a small cap the other day. I can't remember who it was, but I think they were the only ones we've ever seen where it said it qualified as a small cap at the time of buying.
It was early.
Early.
Yeah.
I
so
was
they
thinking
could
in my
actually
head,
let
was it early?
Yeah,
Group?
So
yeah.
they can
So as long
actually
as
They
let
have
it
a
run.
mid-cap strategy now too.
Yeah. Is it small and mid? Or
Small and mid, I
But
think.
I think their rule is if they buy it when it's in the size, they don't have to sell
have to
it
sell, yeah.
until it gets like nuts. Yeah.
Yeah.
I can't actually. That's not the technical description. yeah. I was like, yeah, I agree. It's like
Yeah.
hey,
That's what's in the
let your winners
PDS.
run. Yeah.
Yeah, when it gets
Yeah.
nuts.
Nuts is in the definition section of the legals. Yeah.
Yeah, just something to be aware of, I
Yeah,
think, that there's the different incentives.
One of my favorite terms is time horizon arbitrage. And so arbitrage in investing is taking advantage of mispriced opportunities or like mispricings in different markets where a company is going through challenges or where they have opportunity, but that opportunity is, 5 to 7 years out when it will like be fully realized. Professional investors have to discount that opportunity because it's like outside of their, funds sort of holding time.
Yeah.
And so like there could be something massive coming down the pike, but it's like, we have to discount it because it's too far out. As retail investors, we don't have to do that. And so then you can get some really interesting opportunities where the opportunity might be too far out or the realization may not happen in like a year or two, and they've got to hold something that every quarter they've got to report on. And if it's not delivering, then it's a weight on their portfolio. And so like those opportunities, you can find some interesting mispricings based on different time horizons.
I think also like fund managers are benchmarked, right? Like every quarter or every year, like you have to, or even every month, to be honest. But fund managers often track a benchmark. For example, we track the MSCI All Country World Index. Most Aussie guys do like the Small Ords or the ASX 200. So like they're constantly trying to like beat that benchmark. You don't have a benchmark
Exactly.
as like
Yeah.
a retail investor.
Yeah.
Yeah.
So settle the debate for us. We saw a global growth manager
Who?
that I can't remember who, but they benchmarked themselves to the MSCI All World Accumulation Index. Oh, it was either Hyperion or one of the Loftus, yeah.
Loftus Peak.
And I was like, you know what? Like, respect that they're benchmarking themselves to the accumulation index. Like, you don't see that a lot. And Bryce was like, that's weak. They should be benchmarking themselves to the NASDAQ 100. So what do you think? Weak or not weak?
Accumulation, I respect. Those that don't do accumulation all world and call them and
Well,
do
no
growth.
one else I've seen does accumulation. You guys wouldn't do accumulation, would you?
But
Yeah.
I'm confused. Well, I actually have no idea. Is that like plus dividends?
Dividends,
It's not
right,
that
yes.
there's like
Yeah, total
hardly any
return.
dividends
Yeah.
in like other than Australia.
I mean, it's still an extra hurdle that you got to
but
jump.
Loftus
Yeah.
Peak wouldn't invest in companies with dividends.
No, but they're benchmarking against something with an extra kicker on the return.
Yeah. I don't
My
know.
thing is-
No. The
my
question
point
is
my
MSCI
point is-
All World, weak or not weak?
Yeah, because my
Well,
point
we
is,
invest in-
I know.
that is our benchmark.
On my side, yeah.
to be like the return of the MSCI All Country World Index over the last year was 17.4%, which is pretty high. I think we were like 4th or 5th like among our peer group, which is amazing. Like, hell yes, go team. But in our first year, like kind of awesome. But like there are a lot of funds that did really, really badly. I'm not going to name names. Oh, should I? No.
Yeah, do it.
No. There's some funds that are like in negative territory over the last 12 months. So they've like not only underperformed the benchmark, but they're like literally down 15, 20%. So like that's really, really bad. So I don't know if the MSCI or Country World Index is weak. I don't like the idea of like global funds in Australia only investing in like American type stocks or like English speaking country stocks. I think there's like so many incredible opportunities outside of that. But what do I know? I'm just a journalist or former journalist.
No, you can't say that. The whole premise of this is everything we've learned.
What's your final one, Ren?
Oh, final one. I think the most important lesson is anyone can do it. There's no specialized knowledge. There's no secret sauce. It just takes time, and it just takes a commitment to learning about companies, learning about investing, and then staying up to date. Anyone can do it, but you have to be willing to spend the time. And on the flip side, if you don't want to spend the time, there's nothing wrong with just buying the index.
Nice.
See how on brand we are, Ali?
This entire episode has just been like...
Plug for ETFs.
Yeah,
This entire episode, this entire podcast.
That's our job.
If you read our second book, Don't Stress, Just Invest, it is purely a plug for index ETFs.
Wow,
Yeah.
okay,
Yeah.
Yeah, well, I think like if you're obviously there's like value in like alpha and fund managers who can deliver alpha. It's just that like a lot of fund managers don't.
Yeah.
I think it's like, is it 80? The SPIVA data, is it like 80% over the long term?
Over 15 years in the US, it's 10%, and then can't beat the benchmark.
But that's why like quant strategies have become so popular recently. People are happy to just like have a tiny little bit extra than the index. But there are definitely fund managers who have outperformed over long term, and hopefully we are one of them using AI. But yes,
Don't get us wrong, we see a role for active managers, and we have active managers in our portfolio, but I think that people sleep on the power and the wealth creating benefits of just having a strong core and then having active managers that sit around it.
no, I'm definitely not disagreeing with you.
Yeah,
Isn't
nice.
compounding like
Otherwise it would be another-
the eighth wonder of the world?
Yes,
So-
it certainly is.
Well, 9 lessons from over 1,000 interviews. Ali, thank you so much for joining us today.
Thank you.
I'm sure we'll do it again.
It was really, really fun. I really enjoyed it. Thank
It was
you
good.
guys.
Thanks, Ali.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.